All right, all right, all right. Good morning, good morning. How's everybody doing this bright and early morning? What a dull day. Rain all week long. All right, well, that's the way it works, right? So that's why we're inside. We have jobs. We don't have to go outside and work in the rain because we work here. We play our adult video game. Now, not that kind of adult video game. This is just a video game for adults, right? All right, so the way we're working this out today is we got a very important concept that I want to run by you. Plus, I got some questions that came in from some of the students that we want to answer as well. So if you look out on the little marquee, out on the little YouTube thing, here, I'll pull it up real quick. We have a little picture here of what we're going to be talking about today. So that little picture in here says we're going to be talking about sunk cost ETFs, my high yield ETF strategy. Now, I know it doesn't sound exciting. This is not a clickbait something, click. That's not something that a million people are going to click on and say, oh, I want to know all about sunk cost ETFs. But it's very important for those people who are serious about making money in the markets. I mean, if you're just looking for clickbait and you want to, look for controversy, oh my gosh, look at what that guy said, then this is not your class. If you're just interested in learning how to make money, then we need to talk about this. All right. So learning how to make money is an important issue in my world. So let's just break down the most important parts and get started. So what is a sunk cost? Now, when we trade, we oftentimes tell you, what do we say? We say, trade, run your trading as a business. All right. So I call us stock market entrepreneurs. All right. If you come and study with me, you are a stock market entrepreneur and you are trying to make money, a living. You're trying to run your business through the stock market. Now, I oftentimes tell people when you come to my class at the university, and I teach class at the university on finance, when you come to my class, one of the very first things I'll tell you is that the stock market is like a big sandbox. It's like a big sandbox, all right? Of course, I'll oftentimes tell you that it's like a big carnival game. It is. It's a carnival game, sandbox. But in our sandbox, we can run any kind of business structure you want. You can run a business structure where you're going to buy low, sell high. That's the most common. I'd say that probably the majority of people who trade in the stock market, they do the buy low, sell high mentality. All right. So buy low is they just try to buy the stock lower and sell it when it gets higher, right? And make money. So that's kind of the big understanding of how people trade. Now, there's also the big group of people who buy and never sell. You got to take that into consideration too. So if you take these different models, all right, and of course, then there's the income people who want to make an income. That's what we are. We're the group of people who want to make an income. All right. So if you're not an income person, go. This may not be for you. All right. If you don't want to make money in the stock market and spend it, then what I'm teaching you is probably not for you. You go to some other YouTube channel and watch what they teach. All right. But if you want to run your stock investing like a business and you want to use it to live off of, make an income, that's what I teach. All right. Because that's what I want to do. I don't want to go work for a living. I don't want to go out and in that doldrums and pound nails and put up walls and houses. That's not me. I don't want to do that. I want to run a business. I want to be an entrepreneur and make money. And I want to do that through the stock market. That's how I make money. All right. So if you're just a long-term investor and you're just going to buy and hold and say, well, I'm going to have that money when I retire in 40 years, that's nothing wrong with that. I'm not saying that but I'm already past that stage. I'm already looking at retirement. I'm like almost 65 years old. I want to use the stock market as an income source. That's why I call it the UBI, Universal Basic Income. All right. So in our model where we have lots of different business structures that we can build into the stock market, then we can design our mathematical models, basically, is what this is. We can design them after what goes on in the real world. So if you like real estate and you like to buy a house and rent it and then live off the rent, Well, you can reproduce that same financial structure in the stock market. All right, you can do that. There's many ways that you can create an income source from a revenue source. All right, and a revenue source from an asset. So we have an asset, which is a stock, and then you can generate income from that asset. And it doesn't have to be buy low, sell high. When you go into the real estate industry, you don't go out and buy a house, and then when the house went up in value, you don't sell it to capitalize on the profits. Now you can, but most people want the rent, right? You want to live off the rent. And there's a term that says, well, I need 8 doors, or I need 6 doors, or I need 3 doors. Doors meaning houses that they're collecting income from. And depending on how much money you need and how much you're renting your doors for is how many doors you need. All right. So you determine how much money do I need to live, and you buy that many houses, that many doors, and then you rent them, and then you can back into the amount of money that you need. And we can do the exact same thing in the stock market. All right. Because there's a number of ways that you can own an asset, a stock, and then derive income from it. One of those is dividends, right? We know that if we buy a stock and we get dividends, well, that's great. We can live off the dividends, and we don't have to sell the stock. We don't have to sell the house. And that's one business model. So there's 2 business models for you. We can buy low, sell high, right? Buy low, sell high. That's one business model. There's a second business model. You can buy the asset, don't sell it, live off the dividends, right? The rent, that's a second version. And then there's a third version that I like to talk about, okay? There's a third version I like to talk about, which is the business model. All right, and that's the model I like. I like the business model best. So in my lifetime growing up, I've owned several businesses, a number of businesses. I still own a couple of businesses. But one of the businesses I owned, right, I had multiple employees. I had like 20 employees at one point. So my business was a small business, but it was a nice little business, and I ran my business. All right, and that's what I did. I had products, I would sell them. I had employees, I had expenses, I had things that I need to work into. And so I want to be a stock market entrepreneur. I want to build a business in the stock market like I did in the real world. So all of these real world scenarios that we talk about, buy low, sell high, rent, run a business, you can reproduce in the stock market if you set up your strategy properly. And that's why we talk about understanding and having a strategy when you go in and you start to go into the stock market. Now, there's a really good article by Claire Christensen in Pitt News Magazine this month in the January issue. How many of you got your January issue of Pitt News Magazine? Hopefully you got your January issue. There's a great article in there by Claire where she talks specifically about that kind of that subject matter, where in the olden days, money was almost like loud. She says, she calls it loud. Money was loud. And she comes from a ranching background. And so she's like, you know, the tractor, the cows, the horses, the fences, all that kind of stuff was loud. Money was loud. You actually worked money. She says nowadays it's not like that. You don't have, not that there's still that out there, but for the youth and for younger people, money is quiet. It comes to you on your cell phone. It's like it's like a little ding on your phone or a notification, and suddenly money's so easy and it's easily accessible. The whole concept of having money in an old bank system where you had a pass card or a book where you'd have to go in and talk to somebody named Linda, right? Have to go in and talk to somebody named Linda at the desk to get your money and to put money into the bank or take money out. Those days are gone. So we don't really do that much anymore. Maybe for a special occasion or something, but most everything we do is done on the phone. And you can have your bank doesn't have to be local. You can have a bank that's somewhere halfway around the world, right? And you can still do all of your banking right on the phone because money is easily accessible. It's not loud anymore. And that's a good thing. Convenience is great, but it's also a bad thing because it gives you access without structure. So it gives you access to money without structure. And so kids nowadays, 15, 16, if they can get their parents' approval, right? But 18-year-old kids can go out and they can download an app on their phone and they can have access to the stock market, the whole world of finance, faster than nothing. Faster than we can get in the car and go to the grocery store. You can have access to the whole world of finance on your little cell phone. And so these people are coming in at 18 years old, 19, 20 years old, and they have this entire world access to finances that we've never had before. Money to us was, there's very much structure built into it. You would have your little passcode. You'd go to the bank. You have money. You had a balance sheet that you would have in your pocket that you'd have to carry with you, show you how much you put in, how much you took out. The whole thing is right there, and you'd have to write it down, right? And a little lady would have to sign off on it to show that you put it in. I mean, the world has changed quite significantly, and I'm not saying it's bad. I'm just saying that there was more structure back then. We had penny candies, and right, we would look at how much money we had on our balance. We would go down and we'd buy our penny candy, and we'd come back and we'd look at our little pass sheet. And I just spent this much. I have to take this much out of the bank, and it was a it was a physical event that occurred. Now, I'm not saying it's not the same. It's the same. It's just all digital, but it's so easy that sometimes we lose some of that structure. And because we have such easy access to the stock markets, and we have such easy access and no structure, this is why young investors, young traders lose so much money. And you see them out on the Twitters and the YouTubes and these places and these forums, and they'll show you screenshots of their little iPhone thing, and they'll, oh, look, I just lost $25,000, and they don't think anything of it. Oh, well, it'll come back. Oh, this stock market will come back. I just lost 25. Ha, ha, ha. Funny, funny, funny. Isn't it great? Oh, it'll come back. Oh, I feel bad today, but I'll be better next week. That type of mentality is somebody who's entered into a world that they don't even understand. They don't understand that there's an entire structure behind this thing. And so what I want to do is I want to make sure that we talk about the structure. And one of the focus, and I can't teach you everything in one class, of course, but we can kind of touch on the ideas and the concepts and kind of get you thinking, I need structure to my investing. What kind of an investor am I? Am I going to be a buy low, sell high guy? That's what most of these kids are trying to do. And it's a really hard way to trade. The second of all is, am I going to be a buy and hold guy? Am I just going to buy some stocks and just keep putting a little bit in there every year until I get 65 years old, and then maybe I'll start taking a little bit out every year? That's nothing wrong with that. That's a sound strategy. The only problem with that is that you might be putting money in all the way through for 20 years, and then when it's time to start taking it out, the market flushes and there's nothing in there, anything more than what you put in or less than what you put in. So my strategy, what I like, is I like to take profits along the way. I like to, as the market grows and makes me money, I'll take it out and either spend it or reinvest it. I've got a buddy who says he likes to take his money out, run it, like I taught him. He says, yeah, I take it like you do. I take the money out, but then I put it into equipment in my real physical business. So he lets the stock market fund his real business. All right. So that's a nice way to do it too. You don't have to just put the money back into the financial markets. You can go spend it if you want to, go on vacations or, have a better life, and that's okay too. Nothing wrong with that. But to take the money that you make in the stock market, take it out of the stock market where it's at risk, put it into a physical asset that you might have in your business and grow your business. So there's a number of ways you can do this to gain wealth. And so I want to talk specifically today just about the one subject, the sunk cost. All right. So let's go into Grok, and I pulled up just a definition of what a sunk cost is. So a sunk cost in business refers to any expense that has already been paid or incurred and cannot be recovered, regardless of future actions. These costs are irrelevant to future decision making because they're a sunk cost. All right. They can't be changed or refunded. For example, if a company spends $1 million developing a product, but then discovers that the market has shifted, that $1 million is a sunk cost. Continuing to invest more just to recoup it would be a mistake, often called the sunk cost fallacy. Instead, decisions should be focused on future costs and benefits. This concept is key in economics and management to avoid irrational commitments based on past investments. Now, this goes in several ways. Now, if you think about sunk cost, when you go in and you buy a stock, there is a cost to buying that stock. All right. It's just like any investment. So let's go into my business, for example, and I make pencils. All right. I have to buy a pencil making machine. So when I buy that pencil making machine, does that pencil making machine have value? Yes, it does. It has value. It has a cost to it. I have to buy that machine. Now, that machine is going to produce pencils that I can then sell and make money. In my article in Pitt News Magazine, I use the example of steering wheels. All right. So we're going to buy a machine that makes steering wheels, and we're going to sell those steering wheels to Tesla. So Tesla's going to buy our steering wheels. Now we have a machine that makes steering wheels. That's our product, our steering wheels. We sell the steering wheels for profit. So we can reproduce that in the stock market. All right. How do you reproduce that? Well, you have a sunk cost. You have the equipment that you buy. That would be the stock. All right. And then the stock produces income because it's got, in this case, dividends. All right. So we're going to be looking at high dividend income investments. And the one I want to focus on today is Palantir. Palantir, this one here, the one that's on the screen. And the reason I want to focus on Palantir is because that's the one that, again, there's a January Pit News Magazine is all about Palantir. We have several articles, and the podcast is about Palantir. All right. Palantir is a great company. It was my biggest winner in my stock portfolio last year. So I finalized my stock portfolio from last year. I'll pull it up here real quick, and I'll show you this model that I'm talking to you about. All right. And there's several ways that we can approach this idea of a sunk cost. So this is my portfolio from last year. And you can see I started with $476,000. And as we come across, I'm not going to go through every line item, but I'm just going to come to the end here. And you can see I ended up at the end of the year with a 61% annualized return, or a $292,000 cash profit. All right. So I made $292,000 last year in my portfolio. Now, this is real money. This isn't a demo. This is real money. I can show you every single trade and where all the money came from, where it all went. Now, at the end of the year, I did a lot of dollar cost averaging, or a lot of tax loss harvesting. So at the end of the year, my portfolio only ended up with 5 stocks that I'm taking into 2026. Now, it doesn't mean those are the only 5 stocks I'm going to have, and that's not the only 5 stocks that I had in 2026. That's just the only ones I had on the last day, December 31st of this year. So these are the stocks I'm carrying forward. You can see my sunk cost. Now, I'm going to call this a sunk cost. Doesn't necessarily have to be a sunk cost, but it is a sunk cost. When you buy into one of these high yield funds, it becomes basically like your house that you're buying. You don't really ever plan on selling it because you're just going to take the money out of the house, out of the rent, right? You're going to rent it. So that is kind of like a sunk cost. Now, sunk cost in the sense of what Grok brought it up was more of a negative thing. It was like, well, you spent money and it was a waste of money, so go get past it. We have that type of sunk cost in the stock market too. And we've talked about that in the past. How do you know when you've got a bad investment? Well, you have to have a spreadsheet. If you don't track it, just like in the olden days when we had a little passbook and we'd go to the bank and Linda would reach in and she would sign it and say, okay, well, you just deposited this much money. You have this much money left. This is where your money's coming from. Oh, you're getting some interest on your money, and you can total it all out. You have to do that with your investing, stock investing. If you don't, you're the 20-year-old kid, the 19-year-old kid that got access to the world of finance, and he has no structure. All right. So that's why we use spreadsheets and a combination. I like to use a spreadsheet, but for those of you who might be a little bit, I don't want to call it lazier, but those who don't want to do spreadsheets, there's a software program that we use. And of course, that software program is called Portfolio Matrix. All right. So you can go over to Portfolio Matrix, and it does everything that the software, that the spreadsheet does, plus more. So my spreadsheet, and this is Portfolio Matrix, and right now I've got this up because I wanted to use this little calculator within Portfolio Matrix. But Portfolio Matrix does everything that the spreadsheet does and 1,000 times more. But it does cost a little bit of money. It costs $25 a month to maintain it in here. This is like the best thing since sliced bread. This is the best thing to get into because it's going to help you with all of your mathematics that I'm doing over here in a spreadsheet. But for some of you who don't want to do this, well, I give you my spreadsheet. So you can have this spreadsheet, and I use this spreadsheet to help me with my year-end tax balancing. And so it tells me what we did here. So I've got my capital investment right here, you can see. And I've got this, let's just look at one of them so it's not too confusing. So this is AMD. Let me get rid of some of this stuff. So this is AMD, one of my portfolios. Or let's do an NVIDIA. It's got 115,000 in it. NVIDIA has 36,000. So the market value currently is 35,000 on my 36,000 AMD. Well, I'm down $1,220. It looks like a losing portfolio, right? So you have NVIDIA, which is 24,000. You have OARK, which is 4,000 loss. Palantir, which is $11,000 down. Hey, Lan, I thought you said that was your best one. I have $184,000 invested in Palantir, and its current market value is $172,000. So I've lost $11,000 in Palantir. So this is what I'm talking about when I talk about this type of investing, where we go into these high yield funds. This is your sunk cost. All right. So when you go and you buy equipment, let's say you go buy a pencil maker, or you go buy a steering wheel manufacturing machine. As soon as you buy it, it starts to decay in value, right? It's like everybody says, when I go buy a brand new car, I'll never buy a brand new car. Why not? Well, the minute I drive it off the lot, it loses $5,000 in value, right? I'm going to go buy a used car. It's already lost its $5,000 in value. Okay. Either way, right? However you want to think about that, you're going to go and you're going to lose value in that underlying asset. Now, oftentimes assets will go up in value. And that's really cool, right? Because if you go into the real estate industry and you buy a house, well, the house, it hopefully over time will go up in value, right? Not always, but usually. I mean, they decay too. Houses have to constantly be maintained. They have problems like, the siding gets old and the roof has to be replaced and the sinks go out and you have to have plumbing problems. And there's all kinds of things with real estate too. So don't think real estate is any, gold mine. It still takes work. It's not free. And I have a bunch of real estate, so I understand it from both points of view. But the real estate over time generally goes up in value. You have a lot of property taxes on real estate. And, if your rent can just get you a little bit more than break even, you're pretty happy, because the rent generally just pays for all the expenses that it takes to have real estate. That's been my experience. All right. Because there's just so many expenses in keeping your real estate up that the rent just pays for that. And then where do you make your money? Well, on the growth of the real estate over time. Ends up just being about the only place you make money, if the value of your property is maintained well and it goes up in value. So eventually you can buy low, sell high. You can sell your business, or sell your house, or sell your business structure, and then you got some money, and then you get to pay taxes on that too. So there's all kinds of advantages and disadvantages of both markets. All right. I like to reproduce that in the stock market. I have a little bit more control. I can sell it and buy it at the snap of my finger. I don't have to go out and put it on the real estate market, and I can reproduce that exact model. Just like I say, it's a sandbox. So I can reproduce that exact model in the stock market. So I don't have to do it out in the real world and have to deal with all those other issues. So this is how I've done this. So I've got $184,000 Palantir. I drove it off the lot, and it's immediately gone down in value to 11,000. I'm not too concerned about that, because I look at this as a business. All right. So these funds, although we need to work and spend time trying to make them go up in value, not down in value. We don't like to see them go down. But mine have all gone down since I've got into them, dollar cost averaging. I'm down $43,000. So I've lost $43,000 out of my $402 investment. But the rent that's come in off this was $134,000. So this is the rent that I've collected, or the dividends in this case. All right. So I've collected dividends, and that's $134,000. I look at this as basically my sunk cost. All right. $402,000 is invested. Now, it doesn't mean we can't turn around and go sell our if our steering wheel machine isn't making us money, we want to get rid of it, right? It's a sunk cost. We've lost money on it. It's a bad deal. We should, as Grok says, get rid of that thing, roll it into something else that's making us money. But if you notice, every single one of these steering wheel machines of mine are making me money, even though I've got depreciation on them. So if you look at the loss of this is depreciation. Now, it doesn't mean your machine can't appreciate. If it's making so much money and it's really running well and it's making lots of steering wheels, well, that machine might go up in value instead of down in value. But when we're looking at these yield max funds and these Granite share funds, they have what we call NAV decay. All right. It's called, it's ROC, and then I've kind of coined the phrase ROCC. So ROC is return of cash and capital. All right. So ROCC is cash and capital. So you get your cash, which is the yield, which is over here. This is the $134,000 in dividends that it gave me. So this is my cash. And then the capital, sometimes they give you your own money back. All right. Now it's a structural thing. It's the way they're designed to maintain an income source for you. All right. So they sometimes, if they have a bad month, well, they just give you some of your own capital back. And then it's kind of yeah, it's got two sides to every coin. It's also kind of a dirty little trick. So you pay $10 for your shares. Let's say you pay $10, right? And then they give you $1 back on ROCC. So they give you your capital, or they give you your cash, the money they made, the profits, the dividends, but then they also give you some of your own money back. And the reason they do that is to bring your $10 down to $9. Well, you paid $10 for it. They gave you some of your own money back, so now it went down to $9. What does that do to your percent return? Well, if you're now calculating the value of your percent return on $9 instead of on the $10 you put in, the percent return goes back up, right? Makes it look big again. It's a smaller dollar amount, but it's a bigger percent. That's why people don't like ROCC, all right? Because it's kind of a little scammy. If they give you your own money back and then they keep telling you you're making 80% annualized return, well, you're making 80% annualized return on a smaller investment. 80% of an annualized return on $500 is a lot less money than 80% annualized return on a $10,000. So ROCC, that's the downside of ROCC, is that they have these eye-popping returns, but because they keep returning your own capital, they can maintain those eye-popping percent annualized returns, but it's a smaller dollar amount. All right. So we have to take that into consideration, and that's why you have to make sure you manage your little passbook, right? Which is your spreadsheet, and you can track that. So you know what they're doing, all right? And you know how much money you're making. So that's what we're doing here. So the depreciation or the sunk cost on my equipment, on my machines that I've bought here, AMD, NVIDIA, OARK, PLTY, and GDX, this is my sunk cost, or this is my investment into those machines. This is the depreciation, all right? This is how much I've lost on those machines since I bought them. They've gone down in $43,000 in value, but they produced $134 in yield. So if you run a business, you know that that's exactly the kind of thing you deal with in business. If you're a manufacturer, you buy a machine, and that machine slowly wears out. You're going to have to eventually replace it. So if you use that mentality and you think about this structure that these kids don't have when they're in here banging on their phones, they have no structure. They don't understand any of this stuff. All right. But because you came to my class, now you do. You understand. You've got that structure. Okay, so the structure is that we've got an equipment that we have to buy, which is our sunk cost. We have the value of the equipment today. It doesn't mean you can't sell it and go buy a different equipment. You can, but if that equipment is making you money, why would you sell it? Just because it has a little depreciation. So the depreciation on that equipment that I bought is down 43% or $43,000, but it's produced for me by selling the steering wheels $134,000. So my net yield is $91,000. I've made $91,000 even though the equipment has gone down in value. All right. So now I calculate my months to break even, which is 17.2. So I will have at this rate, if this continues at this rate, in 17 months, I will have all my money back. Everything that I capital investment has been returned to me in 17 months. Now, all of those of you who are in manufacturing and you do this for a living and you've had a business before and you know what it costs to buy equipment and you've done the math on it, of course you have, or you wouldn't be in business, right? You'd be going out of business. Why do 80% of all businesses go out of business? It's because they don't do the math for their own business. Oh, I'm going to go in and I'm going to start a coffee shop. Okay, do that. Have you done the math? You're going to buy that expensive coffee machine. How much money is that going to return? Well, it's going to return so many. If I produce so many cups of coffee a day, I'm going to make this much money. Okay, well, have you done your spreadsheet? Do you know how much money that's going to? How long before that coffee equipment is replaced? And then you have to wear it out and then buy new coffee equipment to make the coffee. Is it a business that's going to be maintained? Are you going to be able to do that? Oh, I didn't even think about any of that. Well, that's why we go to school, right? I don't need to go to school. Yeah, you do. You need to go get some education so that you understand these concepts. All right. That's what I teach at the university. So got to go to the school to learn the things so that when you start the business, you understand the mathematics of the models that you're trying to run. Now, for those of you who want to go to the next step, you can say, well, I don't want to run a coffee shop, but I'd sure like to have the money that's made from a coffee shop. Well, we can reproduce that coffee shop in the stock market. if you have structure and you're not just in there banging on buy low, sell high all the time. If you don't have structure, you're just going to get your ass handed to you. And I promise you that. I've been doing this for 40 years, and I've seen more people lose more money in the stock market than I've ever seen make money. And it's because they don't have structure. All right. They don't understand the concepts. They don't understand what they're playing. They're playing with hot fire, and they don't even realize it. All right. So you need to have a business structure, and you need to decide what your business structure is, and you need to run that model. Whether you're going to do the buy low, sell high model, if that's the case, track it, do it. That's fine. There's nothing wrong with doing the buy low, sell high model. We do it all the time. All right. Or you're going to run the model where you're going to be like a renter, right? You're going to buy the asset and you're going to take the dividends. And are the dividends going to be enough to live off of? That's a model. Or you're going to run it like a business, like I like to do. I like to run it like a business. And we're very lucky that in the last couple of years, these funds have come out and started to do this for us. In the past, we had to do it ourselves, right? YieldMax, they do. They sell covered calls. And Granite Shares, they sell cash secured puts. And so I'm going to talk about that in just a minute, because I have a buddy of mine who sent me a document that he created off of I think it was Grok, might have been either Grok or ChatGPT, but it was an artificial intelligence report that he had created. All right. And so we're going to talk about that here in just a minute, when we get to our question and answer section. And the problem with it is that although it was a beautiful report, Grok got everything completely backwards, or ChatGPT did. I don't know which one he used, but it was completely backwards. It had everything wrong. It didn't. It was a beautiful report. Oh man, he took this pile of shit and he made it look beautiful. Gave it to him like a nice, beautiful present. And if you were to read that and not had the education of what was going on behind the scenes, you would think that that was a beautiful report. You'd follow that and you'd do all the wrong things. All right. So you have to be careful with ChatGPT too. That's especially in finance. I've noticed that Grok, the AI systems don't understand options very well. They're always making mistakes when it comes to trading options. And that's what all this stuff that we're doing with Granite Shares and YieldMax is. It's all options investing. All right. That's what those companies do. That's how they make their money, is they invest in options. And Grok and ChatGPT, they make mistakes in options all the time. They don't understand options very well. The rules for options are they're getting better. They don't make as many mistakes as they did in the first versions. The first versions were just horrible. They just didn't even know the difference between a put and a call. All right, but we're going to set that aside for now. We'll come back around to that in just a minute. We'll talk about that. And I'll show you the differences, and I'll show you what happened. I'm not sure if Larry and Bill are in the class right now or not. If you guys are, you can say hello. But you guys are the ones that submitted that report, and I want to show you what was wrong with it. All right. But that aside, let's go back to what we're talking about here. This is your sunk cost. So my sunk cost is the cost of the equipment. The current value of the equipment. The current value of the equipment went down. Now, we would like to make the current value of the equipment go up. But if it goes down, it's not necessarily a bad thing, because the yield is going to be so much higher than the net asset value of our equipment, right? Or our investment. So our investment went down $43,000, but it produced $134,000 in yield. So the yield was $91,000. So that part of that $292,000 that I made up here is right there. It's that $91,000, and that's still this right here. My equipment. This is all I've got left, because I liquidated a bunch of my equipment that was losing money. Right, had a big NAV loss, and the yield was not as good as I wanted it to be. So I got rid of it for tax loss harvesting purposes, so I don't have to pay taxes on all that equipment, on all that yield. All right, does that make sense? So I got rid of some of those funds, and now I don't have to pay taxes on them, and I have to sit out for 30 days. That's the name of the game. And I oftentimes call this the stock market. It's a board game. All right. And they have to set up all kinds of weird rules, just like you do when you go open up. Probably some of you got board games for Christmas, and you open it up and you lay it all out and you put all the money around and you put your pieces and everybody chooses something. And then you got fake money, but no, we're dealing with real money. But then what do you do? How do you know how to play the game? You lift up the lid, right? And on the back of the lid is all the game rules. So you got all the rules lined out on the back of the game. And so you hold that there and you start playing the game. Well, you can't do that because it says right here's a rule on the game that you can't do that. Well, that's all the stock market is. The stock market is a game. It's like a board game, and it's got all these rules that you're allowed to do and you're not allowed to do. And if you don't know all the rules and you're sitting here playing the game without knowing the rules, that's where you get in trouble. Right? You got to learn the rules of the game. If you're going to come play the stock market game, you got to know the rules. And one of the rules is that when you come to the end of the year, well, you're going to go to jail. Just like, all right, if you don't pay your taxes. So you got to pay your taxes. Well, we want to reduce our taxes to the largest amount we can so that we can win the game, right? Name of the game is make most money, more money than all the other players. Okay. So if we're going to win the game, we got to know the rules. Well, one of the rules is that we got to avoid paying as many taxes as we possibly can. So you look on the back of the board and you already know, oh, how do I avoid taxes? Oh, tax loss harvesting. You can do some tax loss harvesting. Oh, how do I do that? Well, I got to learn the rules of the game, tax loss harvesting. And then we go in and we tax loss harvest so that we don't have to, and I'm not going to go into what tax loss harvesting is, but it's just basically selling off your losers to pay for your winners. And so you're taxed on your total at the end of the year, right? Winners away from losers. And if you had a profit, you pay tax on it. If you have a loss, you don't pay taxes. All right. And then you've got another rule. Oh, well, how much can I write off on my taxes if I actually lose money in the stock market this year instead of make money? Well, you're only allowed to write off $3,000. So if you lost $5,000, let's say $6,000, just to make the numbers easy. If you lost $6,000 this year in the stock market, well, you can only write off $3,000 on your taxes. And then next year, you take that other $3,000 and you can write it off next year. All right. So they only let you write off $3,000, but you can sell all of your losers to pay for all of your winners, and that zeroes out, and then you can write off your losses. But if you have more than you made, well, you made money. Now I'm going to have to pay taxes on $292,000 because I zeroed it out, so I have no losses, but I made $292,000. So now I'm going to have to write a check to the IRS on $292,000. All right. I actually made something like $495,000 in dividends. I actually made more in dividends than my initial investment. I got 100% of all my money back, but I get to write off the depreciation of my investment. All right. So I write off the depreciation of my investment. Now I don't have to pay taxes on $475,000 in dividends because I only have $292,000 in cash after I write off my depreciation of my capital. Does that make sense? Just like Business 101, just like you learned at the university and when you took that Business 101 class. This is what they teach you. Good stuff, right? Accounting 101. You guys take accounting. If you go up to the university, let's say you want to start a business. You don't have to go into Business 101, Accounting 101, Marketing 101, Stock Market, Investing 101. You just have to do all the 101s. And that's good enough education to run a business. So you understand this stuff because this is what they teach you. And then they go into all the greater detailed stuff, after that. But if you just went and took all the 101 classes, you'd be so much more educated than 90% of everybody else who's out there trying to run a business, which is why 80% of all businesses fail in the first, what is it? It's like 80% or 90% of all businesses fell in the first year. And then out of the ones that survived, 80% of those fell in the next 5 years. Makes it tough. It's tough to run a business. If any of you have ever started a business and run it for more than 5 years, you're a superhero, right? You're like one in a very few. Entrepreneurs are kind of a tough crowd, right? To be able to do that. All right, so there we go. Let's come in here and take a look at this. One more step. We got our sunk cost. That's what I want to talk about. We got our current value of our sunk cost. We've got our net asset value. We lost $43,000 in depreciation, went down. We got the yield, $134,000 in production, right? So our net NAV plus our yield is 91,000. So that's what we're going to have to owe taxes on, 91,000 of these right here. Now, for me, there's a bunch that I deleted out of this portfolio. I've got them still, obviously, I've got them all that history over in Portfolio Matrix for me. But for going into 2026, this is all I'm holding. And I made 292,000 last year. 61% annualized return. That's pretty good. And I'm happy with that. Any business that makes 61% annualized return, if I would have been making a 61% annualized return in any of the 3 or 4 businesses that I owned, I'd have been on top of the world. I never made 61% annualized return in my businesses. That's unbelievable. I was lucky if I was making 20, 25, 30%. 30%, I was on top of the world, jumping up and down, playing my fiddle on the roof. Right? I mean, 61% is like unheard of in business. And I know a lot of these guys are banging on their phones. They're going, "Oh, Len, you suck. I made 300% last year in my buy low, sell high." Yeah, but did you keep it? Did you give it all back? And what did you have to, how did you sleep at night? Did you sleep well? It's tough to make that kind of money. 300% return, annualized return. I know there's guys out there on YouTube and Twitter who are bragging that they made 300% annualized return last year. Good for them. I'm happy for them. But what did they have to do to make that kind of money? What kind of risk did they have to take? Holy cow. I mean, can you imagine running a business and making a 300% annualized return every year? What would you be doing in your business? Holy cow, you'd be taking some massive risks. And that's the structure that I'm talking about. All right. The sunk costs, understanding that you've got a cost to doing business, you've got an income source, and you've got a net asset value. All right. And then you got to do the math. That's all there is to it. All right. So this spreadsheet, if you want this spreadsheet, you can get it. All you have to do is subscribe to Pit News Magazine. And for those of you who already have Pit News Magazine, this spreadsheet came out to you this week. All right. In the January issue, this is the spreadsheet that came out. So I've been promising it for 2 or 3 months, and I finally got it put together and sent it to you. I just left all my numbers in there. So you can see my real money portfolio, and for all the old models that are in there, the individual accounts, my traditional IRA. I stopped updating a lot of these older models in here just because I got Portfolio Matrix and I don't need to anymore. But this one here that's called Land's World, this one here I keep updated because that's the one I'm using for tax purposes to do my year-end tax harvesting. So this model is a lot more detailed, right? Has a lot more information in it, but it's not updated. But you can take it and use it. I mean, just because I didn't keep updating my personal data into it doesn't mean that you can't take it and use it as a model if you want to use this model. I use this one. It's a lot simpler. It's a simpler model. And we've talked about it in the past. I don't need to go into it in great detail today. All right. So the next thing I want to do is I want to talk about my buddy. All right. And before I go in and talk about that, I wanted to talk about, let me pull that spreadsheet up one more time. I want to talk about this right here because I was talking to another student. I think it was yesterday or the day before yesterday. It was yesterday. I was talking to another student yesterday, and they don't understand this. All right. They didn't understand this. And I'm like, I've taught it. I taught it. I thought you understood it. So maybe I haven't taught it well enough. I'm going to teach it one more time. All right. We want this number to be as small as possible. Now, I agreed. As I talked about before, if the value goes down, it's like you're depreciating your equipment, and that's okay. And the yield max funds do that as long as the yield is significantly outperforming the decay. When you know it's time to roll out of a fund and get out of it, sell that thing off, sunk cost, get out, take that money and put it somewhere else that's going to start producing money for you. All right. So roll out of that thing when this number is no longer positive over above this number, right? So you have your NAV and you have your yield. And if your NAV and yield is not a positive number, now this one here is GDX. I got into this about back in a couple months ago. All right. So it's just barely starting. I haven't had much time in it. I got into it. I tried to get into it on the dip of gold, and that's what this is. And so I haven't got very much money into it, 25 grand. I just barely put my first tranche in there, and it's losing money because gold is still going down a little bit. So hopefully gold will turn and start to go back up, and then I'll start making money. But if it doesn't, I'm going to have to, I'm going to have to decide whether I want to keep that, or if it's a sunk cost that I'm going to have to get rid of and move that money somewhere else. Fortunately, it's a small amount, but $1,000 down on 25,000 is still a lot of money. So percent wise. So I need to be careful and watch that one very closely, and we'll see if the dividends can't pick up and outperform the NAV decay. All right. So that's my only loser right now, but it's brand new. I just barely put it on about 2 months ago. And so we got AMD. We come in here. You can see it's making money, making money, making money, making money. They're all making money. So I don't really want to dump them yet. Right? I don't need to roll them into something else, but we want to maximize our profit potential on the NAV. Oftentimes you're going to hang on to these, and they're your equipment. They're your business equipment, and you don't buy and sell your business equipment. Just because your business equipment went down in value this month doesn't mean you go liquidate the business equipment if it's making you money. It's still making steering wheels, and you can still buy and sell it. Okay. So the fallacy of trading these markets is that you're supposed to buy and sell them all the time. You don't. You can move them around. You can roll them into other markets, and that's okay if the decision has been made that they're not making you any money. The dividends are not covering the cost of the decay of the sunk cost. But for the most part, as long as they're making you money, hang on to them. Well, how do I know if they're making money, Len? Well, do your spreadsheet. If you're not doing your spreadsheet, if you don't have portfolio matrix and you can't see that they're making you money, then get rid of them. You got to be able to see whether they're making you money or not. Okay? And so now what we're going to do is we also want to be able to trade the markets. So I'm not going to, all right, I got to do it. You got to learn how to trade the markets too. You can't just go and willy-nilly into this thing like the kids do. You can't just go YOLOing into these markets. You got to be smart about it. It's a business. You got to run your business. Okay. And so I have a book that teaches you how to do this. It's called the Fibonacci Effect, the Stock Market Playbook of Strategies. You can go get it on Amazon. And I'm pushing my book here because if you want to run a business, you got to have this education. You got to know how to do what it is that you do to make money. And one of the things, if you're going to run your business in the stock market, you got to know how to trade the stock market. So this teaches you how to trade the stock market. And it's a 101 class. This is going to teach you the 101 stuff. Is there more to learn than what you can learn in this book? Yeah, there is, but I can teach it to you in a 101 class. I'm going to teach it here in the next 10 minutes. I'm going to show you the most important thing for you to do when you're running these yield max funds. All right. So, but go get the book. I don't make a lot of money off of this thing. Amazon makes all the money. It's a 280-page book or 230-page book or something. It's full color, as you can see. You can get the digital version if you want over at pitnews.com in the pitnews.com store. And if you just want to buy the digital version, it's about half the price. But if you want the paper version, which I would recommend the paper version, it's nice to have it. You can lay it out on your desk and you can read it, when you're not sitting in front of your computer. And so you can study it. So go get the paper version out on Amazon. They make all the money, not me, but it's a good guide. All right. And then, so what we're going to do is we're going to learn when we're going to put our money into these markets. Now, I know this is kind of common sense, but nobody does it. All right, it's common sense, but nobody does it. Buy low and don't sell high. Don't sell it unless it's a sunk cost, unless you've determined that it's not making you any money. And you got to do your math. If you're not doing your math, then don't even do this. Don't even trade like this. If you're not willing to do your math, you shouldn't go into business. All right, business is math. And it's not hard math. It's like 101 math. All right. It's not even 101 math. It's like 95 math, 0.95 math in college. It's high school math. All right. To run a business, all you need is high school math. All right. So what we're going to do is we're going to determine when the best time to buy into a stock is. So this is a fund. This is PLTR. PLTR is the underlying stock. John's asking a question. Can you export PMX into a spreadsheet? I don't think so. I think it usually goes the other way around. Everybody wants to import their spreadsheet into PMX. I don't think so. You can ask Ben about that. I don't think you can export PMX. I mean, I never had anybody ask that question. Don't know why you'd want to do that. Maybe if you don't want PMX anymore, you don't want to pay it and you want to just do it in a spreadsheet, but I don't think it's going to work like you might think, John. Just use my spreadsheet. I give it to you for free if you have Pit News Magazine. You just get it. It came to you in an email yesterday. Yesterday's email had a link to that spreadsheet I just showed you when you got your Pit News Magazine. All right, just use that spreadsheet. All right, so here we go. All right, here we go. Here we go. So this is PLTR. All right, and the reason I'm talking about PLTR is because in my spreadsheet, as you can see, it was my biggest winner last year. Okay, I made on PLTR right here. I made $75,000 on that one stock alone. Okay, so out of that $292,000 that I made last year, 75,000 of it came from PLTR. Now, PLTY is the yield max version of this market. It's actually PLTY is trading PLTR. So when you buy and sell into these markets, these yield max funds, all right, you're going to look at PLTR, not PLTY. We don't really care what PLTY does. PLTY is irrelevant basically to us. Other than the fact that's where we're going to put our money when we think it's a buy signal on PLTR. Now, it's called pairs trading. Remember, we've had class about this before. You can go back and you can look into previous videos on my YouTube channel. It's called pairs trading. And so the pairs trading that we're doing, pairs trading also, there's a number of ways of doing pairs trading. But the pairs trading in the sense that I'm talking about it is talking about PLTR versus PLTY. Those are our two stocks. So PLTR, PLTY. All right. So PLTR is the underlying stock. This is what we're actually trading. Now we're not doing the trading. We're going to give the money to YieldMax, and YieldMax is going to trade PLTR for us on our behalf. All right. So this is really just like a cash account in your trading account. You're just going to give them the money. They use this money to back their options trades. So they trade this money. All right. And then when they make money, they put it back into this account, and then they distribute it to you. All right. Every Friday, you get your payment of how much money they made trading PLTR using the money you gave them from PLTY. So you put your money into PLTY, but then you ignore it after that because you don't really care what this chart does. This has nothing to do with technical analysis. You don't look for higher highs and lower highs and all that kind of stuff. The only thing you look on this one is your average cost. All right. So this is where you want to do all your technical analysis, all of your buying, all of your selling, all of your decision making. Now, you don't actually buy and sell here, but all of your decision making for buying and selling is done here. So now we're looking at this market and we're saying, wow, this market has really been high. And it's got a big, beautiful head and shoulders formation up here. All right. Head and shoulders formation, as you all know, because you've been coming to my classes for forever, is part of the Wyckoff theory. So if we bring up the Wyckoff theory, right, and we look, this is our little template, a little guide of how markets have a tendency to move. That doesn't mean they do it all the time, but they have a tendency to move. This little spot right here, you see this up here, is this spot right up in here. So this market's been going through the accumulation stage over here, which is right here. See how it's lined up together? And then it goes up through the big trend, gets up to the top, does this. So that's what's going on up here. And then it's turning and it's going to come back down. Now, this is a really strong market. It may not come back this far, but it's probably going to make some jigs and jogs and come back down into this region here. And if it does, that's where we want to be buyers, right? Now, remember, we talk about this all the time in this class about building upside down pyramids. We don't want to build upside down pyramids, right? If you start buying one share down here and then get up there to the top of your pyramid, how come I can't draw a pyramid land? And then you where's my pyramid? Oh, that needs to be down. That's good enough. You can see my pyramid there. So we start at the bottom with one share, and as the market goes up, we buy more and 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 more. That's what retail traders have a tendency to do. And I've done a little bit of that. And I have to admit, I've done a little bit of that. And I'm going to do better this year. I promise. 2026, I'm going to do better at trying to control my net asset value losses. Okay, I'm going to try and reduce this 43,000. And that's what I'm talking about now. Because this value, although the NAV can outperform it, and we made 91,000, we still lost 43,000. This is a good NAV return. Can't complain about 134,000, but we lost 43,000. So I want to try this year, 2026. I'm going to be more wise about. I'm going to try and be more wise about my capital investments and my sunk costs, and try and reduce the sunk cost a little bit. All right, because when the market goes down, you lose money. Everybody loses money when the markets go down. All right, unless you got a short position on. But these yield max funds, they're not short positions. So everybody loses money. Now they've got short positions, but that's another story. For these right here are not. They're not short. They don't make money when markets go down. AMDY does not make money when the market goes down. It loses money more slowly than other markets when the market goes down. But we still want to buy low, sell high. We want the markets to go up because that's this number right here. All right. So this number, we want it to go up. We don't want it to go down. So we got to be more wise about putting our money in. We don't want to build upside down pyramids. If you start down here at the bottom with quantity 1 and then you add 10, 20, 30, 40, 50, 60, 70, you end up with an upside down pyramid. And then the market only has to fall this far. And then your average cost keeps getting drug up, right? We have an average cost. So if you start down here at the bottom with an average cost of this level, because this is where you bought, and then every time the market goes up, you buy more, well, your average cost keeps going up. You keep dragging that average cost up, 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 and eventually it gets way up here, and the market only has to fall just a little tiny bit, and your net asset value of the equipment that you bought, right, your money, it's losing money, which is what's happening to me in my spreadsheet right here. So each one of these are losing money, right? So they're all losing money because I build upside down pyramids. All right. And it's hard not to build upside down pyramids. It's hard not to do it because you want to do it because the market's going up. You want to participate in the increase in value. It's just how much farther is it going up? And you have to be very strategic about how much you're willing to let that NAV decay go versus your yield, how much your yield's coming in. All right. So now as we come in and we look at this, if our dollar cost average is way up there and the market starts to go down, well, our NAV is starting to lose money, but our dividends are still coming in. Now, the question is, are your dividends going to pay off the NAV? And to say, well, in the beginning, maybe not. It's not going to pay it off. But if the market would just stop going down and just start going sideways, well, I could sell more steering wheels. The NAV will come in, and eventually it'll catch up to it and pay off the drawdown, as long as the market just stops going down, right? If the market would just stop going down, my NAV could catch up, my dividends could catch up. So it just keeps pushing my break-even point further and further out into the future. But Lan, how do I ever get more money into a market if I don't build an upside-down pyramid? Well, we have to put more money into the market. But if the market's just going to come flushing down like a toilet, like it is right now, there's no reason to keep buying into it, which would be a drip, right? Just dripping your money back in, dripping your money back in, dripping your money back in. That would be compounding your losses, because all it's going to do is it's going to keep dragging your average cost up higher and higher and higher, compounding your losses. So don't do that. Don't drip into the market. Be very strategic about putting your money into the market. So what I do is I run these charts. So PLTY, and I look at, and I want to make it very simple for you. Now I'm going to take away, I'm not going to talk about Fibonacci and Elliott Wave and Delta Kona probability and all that confusing stuff. All right. That's trading 201. We're just going to be doing trading 101. Trading 101 is fine. You can do fine with trading 101. So what I've done is I've just got the chart in here, and I've got these little blue lights in here. Now these little blue lights come from the bulls and bears. Now, if you don't have bulls and bears, use parabolic SAR. It's close enough. All right. It's not as good as the blue lights, but it's close enough. All right. And so as we come along in here, you can see this line here. This is a 100 period moving average. See right there? 100 period moving average right here. This one's 200 period moving average. So this is the 200 period moving average right here. And then you got the little blue lights, and then you got the chart. This is the price of Palantir. Now, Palantir is very high. So always remember, you got your map, and you're going to watch the map, and you're going to say, okay, the map. So market's going to go through a low point down here, and then it goes up, and then it's going to go through a high point up in here, just like that, and then it's going to come back down. When it comes back down, this is where we want to start buying down in here. Well, how do I know where that is? Well, you're going to look at it against the previous trend. So once it comes down below the 200 period moving average, that's the best place to be buying it. All right, down in these valleys. Buy the valleys and sell the rallies. Now, we're not going to sell. We're just going to keep buying the valleys because we're going to just keep increasing the value of our machines. We want more steering wheel machines. All right. Now, if the steering wheel machine stops producing, then yeah, you're going to sell it. You're going to get rid of it, but not because you're selling it high to make money. You're going to get rid of it because it's not producing income. All right. The steering wheels are no longer selling. All right. Now, so what we want to do is we want to be buyers when this market's down underneath the 200 period moving average. So down in this region here. Oh, come on, Lynn. Grab the right tool. So down in here, click, 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 circle. There we go. So down in this region here would be optimal, right? That would be the best. But if you look back in time, that market never did come down underneath the 200 period moving average for a long time back because this is such a strong market. So you'd say, well, I would never be able to get into that market. Well, that's true if you would wait for it to come below the 200 period moving average. So what we have to do is that's why we have the 100 period moving average. And you say, but even land all through here, we still would not have been able to get into this market. You're right. That was just too strong. If you didn't get in right here, you missed all of your, there were no more buying opportunities down under the 100 or even the 200, right? There were no more buying opportunities. So all of your buying opportunities are down underneath these two lines. But they also, at the same point, this is what I call decision point trading, where the changes from the green, and we can take off the bulls and bears. The bulls and bears gives you the green, the yellow, so you know when you're in a neutral zone. And market might just be going sideways, right? Like right in here, right in here. These are all neutral zones. But if you don't have the bulls and bears, we can take that off, and it just goes from red to green like that. Okay. Now you need to use parabolic SAR at this point, and then that would give you the little crossovers right there. So right there would be your little crossover. So is that little crossover underneath the yellow dot? No. So is it a you could rank them. You could say this is a 3, right? This is a 3. Come on, 3. And then if that was underneath the 100, that would be a 2, right? And if it was under the 200, that would be a 1. So you can rank your buy signals. So if it crosses the little blue lines above the 100, it's a 3. It's not the best, all right? It's still a buy signal, and then you can still add into your position, but you're going to be probably dragging your dollar cost average up. If it's below if it's below the 100 period moving average and it crosses the little blue dots down in here, oh, that's a 2. That's great. That's better. But if it's down here underneath the 1, beneath the 200 moving average, and you get crosses the little blue lights down under here, that's a 1. That's the best place to be buying in, all right? So you can look at it like that. So that's trading 101. There you go. You want to know how to buy into a market? You got 3 different places you can buy in. You can buy right in there, but that's only a 3. You can buy in if that crosses underneath the 100 period moving average, that's a 2. The best place, number 1, is underneath the 200 period moving average, and it crosses the little blue dots underneath the 200 period moving average. That's a 1. That's where you want to do most of your buying. All right. Where's it at right now? Well, first of all, it's coming down. It's underneath the 100, but the blue dot hasn't crossed. All right. And we can parabolic SAR, we can make it even more aggressive. If you want it to be a little bit more aggressive, we come in here and do that. See that? See where it's crossing? Now, the red dots are way up here now, right? Let's get rid of the parabolic SAR. Let's get rid of this. So all we're looking for is we want to see the parabolic SAR cross underneath the 100. You can buy some there. That's a 2. If it comes down, cross underneath the 1, that's a 3. That's a 1. That's the best down there. This one up here is a 3. It's not the best, but you can make a decision to put some money in there if you want to, depending on where it's at in the structure here, right? Where are you at in the model? Are we in this level here in the model? Okay, well, then you're probably going to be more safe to put it in. This level here in the model, yeah, okay, probably put one in on a 3 if it's a 3. You're going to generally get your 1s and 2s over here on this side or back in here, right? Back coming down into this region here. This is where you're going to get your 1s and 2s. Up here, you're going to probably only get 3s. Okay, but you got to at least wait for the dips, wait for it to cross the little red dots. So that's your trading strategy right there. There's your model. Here's your chart. Here's your 1, 2, 3s. 100 period moving average, 200 period moving average. That's it. You can ignore all the rest of this stuff. All right, because that's trading 201. This is trading 101. That's all you have to do. Now, we're going to take this because we're going to do pairs trading, and we're going to go over to our pair, and we're going to go over to the other chart, Palantir. This is the one this is where we make our decisions to get into the market. But when we get into this market, we don't put the money in here. We put it in over here. So the only thing we track on this chart is our average entry price right here. All right. My average entry price right now is 52.48 on this market. All right. I think I'll double check. Go double check. I think right now for me personally, that yellow line is where my average price is. All right. I'm going to double check on this particular account. I've got multiple accounts, and the only one that I've got right now is here. This is the one we're working with. So my average cost, oh, that's the wrong one, Lan. My average cost is 60.32. Yeah, so actually just up just a little bit. 60, oh, it's up here further. Oh, it's down, 60. Is that a 50 or a 60? 58, oh, 60.32. Okay, that's my average cost. That's close enough. That's where my average cost is. So now I can come in and I can double check that. So now I can come over here and I can say, okay, in Palantir, my average cost is way up there. And that's because I built an upside down pyramid, right? But I had to get into Palantir because it only went up for this last time. So I kept buying in these little dips, but it kept pulling my average cost up. So now as this market comes down, am I going to keep pouring money into it? No, not until I get a buy signal. And when I get a buy signal on my PLTY, it'll be down in here somewhere, and that'll start pulling this average cost down, right? Pulling it down. And ultimately what we want is we want our average cost to be down underneath where the market's trading. So if it comes down, we bring our average cost down, and then the market turns and starts to go back up. Well, now we've brought our average cost down, which is a good thing, right? And what that'll do is that will change our spreadsheet so that this nav line right here, instead of being a negative number, will be a positive number. So you can see in Palantir, I'm $11,000 underwater. That's because $11,000 based on the number of shares I have on this chart, because I'm up in here, right, somewhere around $60. This is that $11,000 loss right here. That's what we're looking at. That's the $11,000 loss, and we're trying to do better, right? This year, 2026, we're all going to work to try and do better on our NAV. All right. Did I hedge? This market is a hedge in itself, if you want to think about it like that. Because yes, you hedged because this was the hedge right here, right? So I traded, which is this, and then this fund trades options, which is the hedge, which is this. So yes, I hedged, but did I hedge my hedge? No. I didn't trade options on Palantir. I didn't trade options against the falling market. Now you can do that, and I did actually. I want to take that back because I did trade some. I did trade some options. Come on, I did trade some options on some of these markets, and so I have another account, a trading account, which you guys all know, which is through Track and Trade, and that's where I trade my options. And so I did trade these markets and make some money as the markets were falling. So I just barely on the 31st. When was the 31st? Wednesday I closed out some positions. So I guess you could say yes, I hedged them. Because on Wednesday I closed out Tesla and Palantir. Or no, it was Tesla and Apple. I had some chicken wings. You guys who know what chicken wings are. I had some credit spreads on, which is kind of a hedge, I guess, if that's what you're asking. So yeah, I had some hedges on it. And I want to do more of that this year. Last year, I was mostly just letting, and I mentioned this before, we're going to be doing more options. I want to do more options. And I taught a class on that just last time. We talked about the option strategies that I'm going to be doing more this year of. Okay. So we're going to be doing more of that. So we'll be doing more hedging, if you want to call it that. But I'm going to be doing more of my own options trading, and try and bring that NAV back. So that's what this whole idea is. If we use this idea and this concept, we can see where our average price is on the underlying PLTY. And then in PLTR, we know what our buy levels are: 1s, 2s, and 3s. We want to do as few 3s as we have to. We want to do as few 2s as we have to. We want to do mostly ones. But if we can't do ones, well, we have to do twos. And if we can't do twos, well, we have to do threes. And we have to take that all into consideration. And that's why you have to be very mindful that your yield is outperforming your NAV loss. And if you trade poorly and you do it wrong, and you don't take care of your NAV loss is going to be greater than your yield, and then you're going to be losing money. So we have to do a good job of maintaining our NAV, making sure that it's not outperforming our yield. Our yield needs to outperform our NAV. And that's the name of the game. All right, that's the answers that I've got for that. I don't want to run over too far over time, but I wanted to talk very quickly about my buddy who was looking at, and I want to just read it to you what he sent me, okay? Just to answer his question real quick. We're going to come in here. And he sent me this really cool report that he did on Tesla. And on the Tesla, he was comparing TSYY. Let's go pull up the chart. He was looking at TSYY and TSYY. And he was comparing it to TSLY. TSLY. Now, remember, I want you guys to remember, we don't trade these two markets. I mean, this is where we put our money, but we don't trade these two markets. We don't want to analyze these markets. We don't do technical analysis on these markets, right? We don't sit here and go, oh, this is going higher. Oh, this is going lower. Oh, I should buy low, buy, sell high. Oh, buy low, buy, sell high. Get in, get out. Oh, based on these markets. We don't analyze these markets. These markets are not for analyzing. They're holding buckets. All they are is a bucket of money that you put money into. They then take that money and trade it in this case, Tesla. And then they take the profits and put them in here. And if there are no profits, they lose it in the market and the market goes down. All right. And then they've also got ROC and ROCC going on. So they got this bucket of money that you put your money in, which is TSLY or TSYY. It's just a bucket of money. It's not, so when you do this type of analysis, like you just sent me this report comparing TSLY against TSYY, and it comes in here and says you should buy and sell, and these are all your strategies and all this kind of stuff. Real world behavioral, what activity, and this is your scenario, and you should do this, and scenario 2, you should buy and sell it when it does this, and you shouldn't hold on to it, and this is a mistakes people make, and then half the mistakes are not the models that we run. So this stuff's all wrong. You can't, AI is really smart, but if you ask it the wrong question, it will give you all the wrong answers just beautifully. It'll package that piece of shit up, and it'll put a little bow on it and a nice wrapping paper, and it'll hand it to you as if it's the greatest present in the world. And if you don't know and understand that that's what it just handed you was a piece of shit, you'll open that up and start eating it. Oh my God, this is the best piece of shit I ever ate. And then you lose all your money because you got to not trust AI to give you all the answers. I love AI, but you got to also have your own education under your belt so that you know when it's hallucinating. All right. Because AI, that's one of the problems with AI right now that they're trying to figure out how to fix is the hallucination. So I'll show you. Very first thing, right off the bat, this is a hallucination. How? Because you come down here and you read it, and I'll read it to you. I'm going to read it to you. It says real world behavior, what actually happens? Scenario A, TSLA, strong trend breakout. What TSLA does? This is TSLA. Okay, this is the underlying stock. Consecutive higher highs, shallow pullbacks, news and momentum results. This is what happens with this is what it says is happening with TSYY. TSYY, it says, captures directional move, strong NAV growth. First of all, that's a lie. That's not true. That's not what happens. Second of all, TSLY, upside is capped. That's true. Underperforms badly. Not true. Okay. Income does not compensate for missed upside. Wrong. It does. Okay. Correction. Rotate out of Tesla into TSYY when Tesla is making consecutive higher highs, shallow pullbacks with news and momentum, which is exactly the opposite of what you want to do. You don't want to do that. Why? Because TSYY is out of Granite shares. They trade put options. And all they're doing is they're selling cash secured put options. They have no upside potential whatsoever. None. Zero. Whereas on the other side, TSLY does have upside potential. Is it capped? Yes, it's capped because they cover a call, put a covered call above it. But they also get in with long synthetics, synthetic long position. So if Tesla, TSLA, rallies hard, which one of these stocks is going to make the most money? TSLY. And it said just the exact opposite of what actually happens. Because a put option, a cash secured put, has no upside potential whatsoever. Zero. Never, ever will TSYY participate in a rally in TSLA. Never. Won't do it. Can't. It's impossible. Impossible for you to make money, more money if the market goes up in TSYY, because all it does is cash secured puts, which is just collecting the premium. All right. TSYY, on the other hand, TSYY buys call options, or they buy synthetic long positions, and then they cap it with a cash secured put. So if the market goes down, it loses money more slowly because it's taking the premium and it's helping you cover your losses. But if the market goes up, well, it gets to capture all that upside potential between where the market's trading and where it capped it with the covered call. So it gets to take all that profit, plus it gets the premium. So this is exactly, this little report that you got is exactly backwards, exactly wrong, exactly the opposite of what actually happens. And it's put together in a beautiful little report. Oh my gosh, I look at this and I'm like, that was really brilliant. Now, I don't know if my student said line it out like that for me or not, because he must have, because it gave this beautiful report. Oh my gosh, it went through step 2, step 3, what happens in all these different situations. If the underlying stock does this, this is what's going to happen to your TSYY. And every single answer is wrong. Every single answer is wrong because it doesn't understand the difference between TSYY and how it makes money versus TSLY and how it makes money. All right. So you just have to be careful when you're using the AI. And he was smart, very smart, because he said, I got this really cool report, and he sent it to me, and he says, what do you think of this? Is this right? And I had to tell him, I said, that's one of the most genius, brilliant little reports I've ever seen that did absolutely everything wrong and backwards. Now, what you could do with this is you could give the AI more information. You could go in and you could say, hey, look, this is how TSYY makes money. This is how TSLA makes money. This is how TSLY makes money. And you could kind of line out the three. Say this one's a stock, this one's an ETF that makes money off of covered put, or off of Granite shares, makes money off of cash secured puts. This one makes money off of covered calls. Now that you've got this additional information, rerun the report, and it might give you something that's really cool. All right. The problem is it doesn't know how TSYY makes money versus TSLY, and it got it completely backwards. Absolutely backwards. So be careful. That's all I'm saying. So I answered that question. Hopefully that helps understand a little bit. It just didn't understand how the two funds made money, and so it gave you a beautiful report that was just completely wrong. All right, guys, that's all I got for you today. It's been a long class, hour and a half. Hopefully you stuck with me. We got more people here than we started with, so I guess that's good. And the only thing I have for you is if you haven't got Pitt News Magazine, I'd really like you to swing by Pitt News Magazine and pick that up. And also the software that I use for this, for my trading and tracking my trades.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right. And of course, for Pitt News Magazine, we got to get Pitt News Magazine. Don't forget Pitt News Magazine.
Look, folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, you know, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
Yeah, you got to get Pitt News Magazine. All right, here's where you...
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, guys, that's it. That's all I got for you today. Let's meet again. What's today? Today's Friday. I'm going to head back down to St. George, get ready for my university classes. Been up here in Logan, enjoying the nice warm weather. Supposed to be a white Christmas, but nope, not up here, not this year. So we did go up in the mountains, and we did see some snow up there. We got wet that way, so we had a good time anyway. This has been a good trip, and I'm looking forward to starting our new classes back at the university starting mid-January, so in a couple weeks. But I'm headed back down this week, and we'll see you guys down in St. George for this next semester. And have a good weekend. We'll see you next week online. All right.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.